Okay, so I'm going to walk you through several illustrations from your Chapter 10 textbook into chapter problems. Okay, so for the first exercise we're going to look at is exercise 10-5, again in your textbook, where we're going to calculate the performance report variances. So what they've given you in this case is a restaurant sales revenue by divisions: food, dessert, bar, catering. They've given you actual sales and budgeted sales, and what they want you to calculate is any variance, and they want you to compute that variance as a percent of your budgeted sales. So all you do is take the differences between actual and budget. You'll say favorable or unfavorable. You want it to be favorable only if actual exceeds the budget. And then once you get the variance, what you'll do is you'll take that variance and you will divide that by your budgeted sales column, and then you'll put that percentage in this column, and it's still the same favorable or unfavorable, the same as what your actual variance calculation was. In the next slide, we'll look at the actual numbers. So as you can see, you go to the variance column, the first one, you take the difference again between actual sales and budgeted sales, you get 1,580. It's favorable because actual is more than the budget. That's good. For the dessert, the actual is going to be less than the budget by 1,200. You'd say unfavorable. For the bar, it's going to be favorable because actual is more than the budget. The difference is 4,050. You'd say F for favorable. And then for catering, again, actual in this case was less than the budget. The difference is 880, unfavorable. Then to get this column right here, you simply take whatever you have in your variance column and you divide that by your budgeted sales. So if you take 1,580 divided by 158,000, that would give you 1%, and you can just do that for the rest of these, but that's what they're wanting you to put in that column where it says variance percentage. Okay, so on exercise S6, this is the next one I want to look at, is your ROI calculation, capital turnover, and sales margin. They've given you three different divisions: functional, consumer, performance. They already gave you operating income, assets, sales revenue, and then you're just going to use your formulas to calculate each of these. So just to kind of remind you, remember to get your actual sales margin, that's when you take your operating income and you're going to divide that by your sales. For capital turnover, it's going to be sales divided by your assets. And for ROI, it's going to be your operating income, again, divide that by your total assets. So on the next slide, we'll walk you through the results. So you can see the answers are up above for sales margin, capital turnover, and ROI for each of these. So right here, they're giving you the numbers you would divide by. So for example, for functional, you would simply take that operating income and divide that by your sales. That would be your sales margin. For capital turnover, again, you take sales divided by your assets, you get 2.2. And then ROI, what you can do is you can just multiply these together. That's going to give you 57.2. Or alternatively, you could also just take your operating income and divide that by your assets. You'll note that that would give you the same answer. You do the same thing for consumer and performance. You just have to plug the numbers into your equation, and all the results are up here. So remember the shortcut, or you could say the expanded formula, they like to call it, for ROI is to take sales margin, to multiply that by your capital turnover, and that equals your ROI. Okay, so on exercise 1017A, we're going to look at, again, at a performance report where we're going to be comparing the actual results to a budget. We're going to calculate the variance, get the variance percentage, and then we're going to answer these four questions down below. So again, number one, they want you again to do this complete the report essentially, and then talk about the type of responsibility center this is. It's got a revenue center, and then we're going to talk about this, which items should be investigated. For example, if part of the management's decision criteria is to investigate all variances exceeding 2,900 or 13%. That's that management by exception idea. And then the question, the last part says, should only unfavorable variances be investigated? And again, we'll talk about that. So again, on the next slide, we'll walk you through the actual numbers. But again, what you'll be doing here is, in this case, it looks like you've got direct material, direct labor, indirect labor, utilities, depreciation, repair, and maintenance. So this looks to me like a cost type of center because you're looking at the cost, not revenue. And so we'll be comparing actual to budgeted. So remember, because these look like these are cost types of activities, you would want the cost numbers, the actual, you'd want those to be less than the budgeted. You'd say favorable. If the actual is more than the budgeted, you'd say unfavorable, because remember, you're always trying to do better than the benchmark, which is the budget. And then once you get the variance column, you'll take the variance numbers and you'll divide that by the budgeted column to get that as a percentage. So as you can see by this table, They went ahead and filled in this budgeted variance column. You just take the differences between actual and budget. So this column represents the differences. You'll say unfavorable if actual is more than the budget. So in this case, for example, for direct materials, it is more. So you'd say unfavorable by 900. To get the percent, you take 900, divide that by 12,500. That's a 7.2% difference on the variance. For direct labor, notice actual costs were less than the budget. That's good. You'd say favorable by 1,060. So that's where they get the favorable, unfavorable. And again, you take these budgeted variance differences, divide that by the actual budget. That gives you the percentages. So that would be the first requirement. The second part says, what type of center is this? And I mentioned that earlier. This one looks like it's a cost center because all these items represent cost. Part 3 wants you to investigate based on a certain threshold or ratio, which items based on their criteria would you investigate. And if you look at the numbers, looks like it would be indirect labor, which is 52.20 difference, and 70.4%, which meets that criteria to investigate. And the other one would be the repair and maintenance, which the difference there is 1,570, or in terms of relative percent, it's 15.7%. Last requirement, answer, you say no. Favorable variances, you should also investigate just to make sure you're not hurting business. So you always want to look at all variances, not just favorable or unfavorable, but usually try to investigate some things, because sometimes even favorable stuff might actually be hurting the company. All right, the next illustration we want to look at is 10-19A. Again, we're going to look at the ROI calculations. You'll note that you've got two different divisions here, residential and professional. They gave you sales, operating income, and total assets. And then, of course, it says that they have a targeted return rate for each division to be 24%. So if you look at the requirements, they want you to, number one, calculate the ROI. Remember, ROI directly can be calculated by simply taking operating income, dividing that by your total assets. You can get that with part 1. And then on parts 2 and 3, they want you to calculate the sales margin, the capital turnover. You'll then take these two items, you'll multiply those to get the same ROI. So whatever you get in part 1 should be the same as part 4, but they're called this the expanded equation formula. You should be able to take sales margin, multiply that by capital turnover. That should also give you the ROI. And then, of course, the last step, what we're going to do is we're going to calculate this thing called residual income. Remember, that's where you take your operating income and you subtract out whatever your target number is. That's the income above your minimum. In this case, because 24% is their target rate, your minimum target rate will be 24%. Multiply that by your assets. When you take operating income, you'll subtract that. That's how you'll get part 5 on residual income. And then we'll look at the overall interpretation of the results. So again, if you look at part 1, it's real simple. It's just your ROI. You just take operating income, divide that by your total assets. For residential, you get 36%. For professional, you simply would get 42%. So that would be part 1. So if you look at part 2, they want you to do your sales margin, which is your operating income divided by sales. Again, for residential, you would get 12%. For professional, again, you just divide, you'd get 15%. Then on part 3, you get the capital turnover. And again, on that one, you take sales divided by total assets. Again, you just have to divide. So for the residential, it's 3. And for the professional, it's going to be 2.8. Now on part 4, what you'll do is you're going to multiply the sales margin, whatever you have for sales margin, multiply that by your capital turnover. That's going to equal your, or should equal your ROI. So for example, for the residential, you'll take that 12% and multiply that by 3. That should also give you the same answer that you got right up here, which it looks like it is. That's 36%. And then for the second one, again, you'll take the 15% for professional. You're going to multiply that by 2.8, and you should get the exact same answer of 42%. So on requirement part 4, they went ahead and put the results up here. And just like I put on the previous slide, you'll note that you should get the same RI that you got in part 1. Then on part 5, they wanted you to do the residual income. So what you do is you take your operating income, which was given. Here's your target. Now again, to get your target, you take that percent, which in this case it was 24%, and you're going to multiply that by your assets. So they did that right over here. And then what they came up with is for residential, they got residual income of $23,400, and for professional, they got residual income of $65,160. Okay, so this is exercise 1021A. I wanted to walk you through another one on ROI and residual income. So again, they've given you operating income, total assets, current liabilities, sales. Here's your targeted return of 16%. They want you to do sales margin, capital turnover, your ROI, and then they want you to calculate again your residual income. So basically, just like the previous slide, you go through your formulas on ROI. You can also use sales margin times your capital turnover to get your ROI, and we'll show you those calculations on the next slide. So again, if you look at requirement on part 1, to get your sales margin, again, you take operating income and divide by your sales. So you should get that right at 28%. For your capital turnover, it's your sales divided by total assets. So here's your 27,000 sales divided by your total assets of 12. You get 2.25. That's your capital turnover. And then operating income is simply your operating income divided by your total assets, which they got 63%. Or alternatively, you could just take the 28%, multiply that by the 2.25. Again, take the 28%, multiply that by the 2.25. That should also give you your ROI. On part 2, to get the residual income, again, here's your operating income. Your target would be, your target rate, in this case, it's 16%. You're going to multiply that by your assets of 12,000. That's in the parentheses. You deduct that from operating income. In this case, the difference should be 5,640 as your residual income. Okay, so the next illustration I want to look at is exercise 10-24A. And on this one, we're going to be looking at a flexible budget. And so what they give us here is that they sell muffins to restaurants and coffee houses. They give you the budgeted selling price, which is $27 per case. They then give you the following information related to the budget. Now notice they'll give you budgeted sales in units, that's the cases. You will not need that number for the flexible budget because remember on the flexible budget you're going to use the actual sales. But everything else you will use. You've got packaging costs per case, you're going to need that. That's going to be a variable cost. Per unit, that's a budgeted number, but you will need that. The shipping expense per case of $3, you'll need that, as well as the percent of your sales price, which is your 4% commission. So these 3 items right here, these are going to be your variable cost, but these are going to be based on the actual volume, not the budgeted volume. And then everything else is basically going to be your fixed expenses. Then on the next slide, they're going to show you some of the actual data. So I'm going to take you to the next slide, and then we'll show you how to put together the whole budget. So you'll note to conclude this problem, they tell you that during the year, this is going to be the actual volume. That's what you will use for the flexible budget. This is the actual sales revenue right there. And then everything right here is basically the actual results. But I'm trying to bring this up. This volume right here, you want that volume in your flexible budget. You do not use the budgeted volume. So now on the next slide, we'll show you what the flexible budget looks like. Okay, so you'll notice we've got 3 columns here. We've got the actual, notice 8,100 cases. Notice we've got the flexible budget. Notice same volume. And then notice the master budget you're still using, that's the budget number, okay? Now, you'll notice that your variable expense category, these next 3 items, the actual, go back, they gave you these numbers. For the flexible budget, the way you're going to calculate these numbers is you're going to take this volume of 8,100 and you're going to multiply by these units. So for example, for packaging expense, you would take $8,100 times $1 gives you 8,100. $8,100 times $3 gives you 24.3. Now to get the commissions, you got to multiply by the revenue because it's sales price. And I believe the actual budgeted number there was 27 per case. So that's how they got the 218,700. They took 8,100 multiplied by $27. That's your flexible budget revenue. Now to get the commissions, this is going to be 4% of this number. That's how they got this estimated commission cost. And then of course you would just pull these numbers right from your budget as is. Those are your fixed costs. Now look at the master budget. The master budget is based on the budgeted volume. To get this 213.3, they still multiplied by the same revenue, which is $27. And then to get these numbers right here, again, it's just using this volume multiplied by these variable costs per unit, and of course the commissions would be 4% of 213,300. So that's where they would have gotten that 85.32. And the differences obviously between flexible budget and master budget, notice you're using different volumes. That's where they're going to get these differences. Notice that the fixed costs are the same for both the master budget and the flexible budget, so those are the same. The only difference is with the variable cost, and it's all based on volume. So quite literally, what you really want to look at is this variance right here, where you're comparing flexible budget to actual. This is an apple-to-apple comparison because you're using the same volume. So when you compare packaging expense of $8,600, that's the actual, to the $8,100, this $500 unfavorable variance is something that's actually a valid variance to look at to try to explain why did you spend more than you thought you should have, and the same thing for the shipping and the sales commissions. So this is how you put together the actual. You got the flexible, which again, flexible is based on actual activity, and the master budget is based on that static budgeted number. And then at this point, you can then do your differences and your comparisons. Remember, when you're comparing actual to flexible, when you're comparing your expenses, you want the expenses to be less than the flexible budget. When you're looking at revenue, you want the revenue to be more than the budget. And then you can do the differences, get your favorable, unfavorable, and then at the end of the day, eventually what you would do is start to, estimate, or you start to investigate some of these variances to figure out why you were favorable or unfavorable. So this is 10-24A.